Hello everyone and welcome back to the channel. Last week we took a deep dive into DGRW, the dividend growth leader. If you haven't seen that yet, make sure to check it out. Today we are shifting gears to a very exciting opportunity in the investment world, the top REITs for long-term growth. Did you know that some REITs have outperformed the broader market over the past decade, not only offering stability, but also delivering impressive returns? That's right, and in this video, we're exploring some of the best real estate investment trusts or REITs. These aren't just safe harbors, they're real engines of growth for your portfolio. Real estate can be an excellent addition, providing diversification and a steady income through dividends. We'll examine which REITs offer the greatest potential for long-term growth and discuss why adding them to your portfolio could be a strategic move for anyone looking to seriously expand their investment horizons.
I'm going on and on. My wife told me I need to share more.
As we delve deeper, let's discuss why REITs are considered a valuable component for long-term investment strategies. First off, REITs provide an accessible way to invest in real estate without the need to buy or manage properties directly. This accessibility opens up opportunities for individual investors to benefit from real estate's long-term appreciation potential. REITs are not just about appreciating value, they also offer remarkable stability. Unlike more volatile stocks, real estate markets typically experience more gradual fluctuations. This stability, combined with the potential for property value appreciation, positions REITs as a strong contender for any long-term growth portfolio. Furthermore, REITs are renowned for their dividends. By law, they are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. This policy ensures a consistent income stream, making REITs an appealing option for investors who are looking for regular dividend income in addition to growth. In summary, investing in REITs means tapping into the long-term growth potential of real estate while enjoying the benefits of steady dividend-driven income. This combination is what makes REITs a staple in diversified investment portfolios aimed at growth over time. Next, let's explore the reasons why you should consider investing in REITs for long-term growth. We'll look at how they align with the benefits we've discussed and how they can meet your specific investment goals. Now that we've introduced what REITs are, let's dive deeper into why they are particularly compelling for long-term growth strategies. While it's clear that REITs offer an accessible way to invest in real estate, their long-term value goes beyond simple accessibility. Consider the historical performance of REITs. Over the decades, REITs have not only matched but often exceeded the performance of broader market indices, especially during periods of economic stability and growth. Their unique structure, requiring them to distribute most of their taxable income as dividends, also provides a double-layered benefit: consistent income and reinvestment opportunities for compounded growth. Beyond the role in providing stability, REITs can significantly appreciate in value. This appreciation is driven by underlying real estate assets, which tend to increase in value over time. When combined with strategic management such as acquiring and improving properties or expanding into high-growth regions, REITs can offer substantial growth potential. And let's not overlook the consistent income stream. This isn't just about regular dividends, it's about the quality of those dividends. The income from REITs tends to be more stable and predictable compared to other high-yield investments, which is incredibly valuable in long-term financial planning, particularly for those near retirement or seeking reliable income sources. This combination of growth potential and income stability makes REITs an excellent option for investors looking to enhance their long-term investment portfolios. And look guys, they're not just another liquidity investment, they are a strategic tool designed to offer both security and growth. With these advantages in mind, let's next explore how to identify the REITs that best align with your specific financial goals and investment strategies.
I want you to deal with your problems by becoming rich!
Firstly, when we're deciding on the top REITs to pick, we need to look at the financial health. It's paramount, and this includes looking at factors like debt levels, cash flow stability, and occupancy rates. A healthy REIT should have manageable debt and consistent cash flows, which ensure it can maintain dividends even in less favorable economic conditions. Next, historical performance is a good predictor of future behavior. While past performance isn't always a perfect indicator, REITs with a history of steady growth and strong performance in various market conditions typically offer more security for long-term investors. Finally, the quality of management cannot be overstated. Effective management teams are skilled in property acquisition, development, and maintenance. They should also be adept at capital management, navigating market fluctuations, and strategic reinvestment. So why are these criteria so important? Well, they collectively indicate an REIT's ability to sustain and grow its operations over time. Financial health ensures resilience against economic downturns. Historical performance offers insights into potential future success, and strong management contributes to ongoing value creation and operational efficiency. Understanding these selection criteria will equip you to pick REITs that are not only stable and profitable today, but are also positioned for sustainable growth in the future. Now, let's apply these criteria as we look at some of the top REITs currently on the market.
I have been a rich man and I have been a poor man, And I choose rich every fucking time.
Firstly, let's take a close look at Realty Income, known as O, a standout for its long-term potential and strong dividend history. It manages a diverse portfolio of over 15,450 commercial properties across 86 industries, maintaining an impressive 98.6% occupancy rate, which underscores its market stability. In the year of 2023, Realty Income strategically invested $9.5 billion at a 7.1% initial cash yield, focusing on companies that support sustained cash flow and dividend growth. Financially, O shows robust performance with net income of $872.3 million or $1.26 per share. With that, O boasts an adjusted funds from operations of $2.8 billion or $4 per share, indicating operational efficiency. Despite recent underperformance relative to the S&P 500 with a one-year negative return of negative 8.1% compared to SPY's 22.7%, Realty Income remains financially sound with a healthy debt-to-equity ratio of 67.78%. This slight dip is largely attributed to the high interest rate environment affecting many real estate investments. Nevertheless, its consistent monthly dividends yield approximately 5.7%, significantly higher than the S&P 500 average, making O an attractive choice for income-focused investors looking for stable long-term returns. Turning our attention to our second REIT is Vici Properties, widely recognized for its unique focus on experimental assets. In 2023, Vici's total assets grew to $44 billion, marking a significant 17.26% increase from the previous year, demonstrating strong growth momentum. The portfolio includes 54 gaming properties and 39 other experimental venues across the US and Canada, plus 4 championship golf courses. This diverse and entertainment-focused portfolio not only attracts a wide range of tenants, but also ensures resilience against economic fluctuations, enhancing its long-term growth prospects. Vici has also been proactive in expanding its portfolio, investing $1.8 billion in new properties last year with an impressive unlevered initial yield of 7.7%. This strategic investment in high-yield properties reflects a keen eye for growth opportunities that can generate substantial long-term returns. Looking ahead to 2024, Vici anticipates its adjusted funds from operations to range between $2,320 million and $2,355 million, indicating expectations for continued financial health and operational efficiency. Although Vici's performance was a modest return of 2.3% over the last year, it trails behind the S&P's 500 gain of over 22.7%. The specialized focus on experimental real estate provides a stable income stream with potential for appreciation in asset values. Such strategic positioning combined with consistent investment in high-potential properties positions Vici as a compelling choice for investors seeking sustainable long-term growth within a niche market. Lastly, let's discuss Federal Realty Trust, a stalwart in the REIT industry. With a portfolio that includes 104 properties and over 2,800 residential units, Federal Realty stands out not just for its size, but for its remarkable consistency in rewarding investors. It has increased its quarterly dividends for 53 consecutive years, the longest record in the REIT industry, showcasing its commitment to shareholder returns. In 2023, Federal Realty achieved a revenue of $1.13 billion, up from $1.07 billion the previous year, reflecting steady growth. The company's earnings per share stood at a robust $2.80, underscoring strong profitability. In the first quarter of 2024, FRT reported funds from operations of $1.67 per share, a slight increase from $1.65 a year ago, with the annual FFO last year reaching $6.55 per share, the best in its 62-year history. Despite a modest 1.5% return over the past year, which lagged behind the S&P's 500 gain of 22.7%, Federal Realty's long-term performance and strategic position remain compelling. Looking ahead to 2024, FRT projects a forward annual dividend yield of 4.16%, signaling a positive outlook. This forecast makes Federal Realty an attractive option for investors seeking reliable income streams, underscoring its potential for sustained long-term growth. As we wrap up our discussion, let's compare our selected REITs, Realty Income, Vici Properties, and Federal Realty Trust side by side to see how they stack up against each other based on the criteria we've discussed. This will help us understand which REIT might be the best fit for your investment portfolio depending on your specific needs and goals. Looking at our table, you can see that each REIT has its unique strengths. Realty Income, with its broad diversification and consistent dividend performance, is ideally suited for investors looking for stable income and modest growth in a variety of economic conditions. Vici Properties, with its focus on experimental real estate, offers a unique angle. Its assets include gaming and leisure properties, which might appeal to investors looking for exposure to these specific sectors of a blend of income and potential for appreciation driven by sector-specific growth. Federal Realty Trust, known for its impressive record of dividend increases, is perfect for those who prioritize dividend reliability and growth in the retail and residential property markets. Its long history and consistent performance makes it a solid choice for conservative investors focused on long-term capital preservation and income. To summarize, your choice will depend on your risk tolerance, growth expectations, and sector preference. Whether you're looking for stability, sector-specific investment, or proven dividend growth, one of these REITs could enhance your portfolio's performance and meet your investment goals. This comparative analysis should help you make an informed decision about which REIT best aligns with your investment strategy. Remember, diversifying your portfolio with with different types of REITs could also be a wise approach, leveraging the unique strengths of each to balance risk and reward.
We Jump Street, and we're about to jump in your ass.
While REITs offer many advantages like any investment, they also come with their own set of risks, which are important to understand before you decide to invest. First, let's discuss the general risks. REITs are particularly sensitive to changes in interest rates since they often rely on borrowing to finance acquisitions. Rising interest rates can lead to increased borrowing costs and compress their margins. Additionally, because REITs must pay out most of their income as dividends, they often have less cash on hand, which could be a risk in downturns when financing is tighter. Turning to the specific risks of the REITs we discussed, realty income, VICI properties, and federal realty trusts each face unique challenges. For instance, realty income with its diverse portfolio might be exposed to sectors that could underperform due to economic shifts. VICI properties focusing heavily on gaming and leisure could be impacted by changes in consumer spending habits or regulatory changes affecting the gaming industry. Federal realty trusts, with its focus on retail and residential properties, could be vulnerable to the retail sector's volatility, especially with the increasing shift towards online shopping. Each of these sector-specific risks could affect the overall performance and stability of these REITs. It's essential to consider both these general and specific risks when evaluating REITs as part of your investment portfolio. Understanding these risks can help you make more informed decisions and ideally position you to manage and mitigate these challenges effectively. Balancing these risks with the potential benefits is key to a successful REIT investment. Diversification within your REIT holdings and broader financial planning can help cushion against potential downturns and capitalize on the growth opportunities that REITs can offer. As we wrap up today's discussion on REITs, let's quickly recap the key points we've covered. We explored three distinct REITs: realty income, known for its diversified asset base and consistent dividends; VICI properties, which specialize in experimental real estate like gaming and leisure properties; and Federal Realty Trust, notable for its long history of dividend increases and its focus on retail and residential properties. From our analysis, each of these REITs has unique attributes that can serve different investment goals, whether you're seeking stability, sector-specific exposure, or consistent income. Personally, I find the long-term dividend growth potential of Federal Realty Trust particularly compelling, especially for those who value historical consistency and sector diversity in their portfolio. I recommend taking a closer look at each REIT's performance metrics and considering how they align with your own investment strategy and risk tolerance. Remember, diversifying your investments is key to managing risk while potentially enhancing returns. Thank you all for tuning in today. I hope you found this overview of different REITs informative and helpful as you consider diversifying your investment portfolio. Make sure to join us next time as we take a deep dive into VOO, the Vanguard S&P 500 ETF. We'll explore why it's a favorite among investors looking to mirror the performance of the US stock market and how it can fit into your investment strategy. This will be out next week, so please watch out for that, guys. If you enjoyed this video, please give it a like, share it, and don't forget to subscribe for more in-depth analysis. Also follow me on X @MushT, where I share daily insights and updates on the market that you don't want to miss out. If you guys have any feedbacks or comments, please put them down below. But until next time, keep investing smartly, and I'll see you guys in the next video.